Hello, this is the Finance Circle. Today, we are launching our first YouTube channel. We're excited to be here, and we're looking forward to talking to you about interesting finance stories from a global perspective and in light of global standards. The first title is Private Equity Unveiled, and the subtitles are Pretty Woman and Private Equity Funds. I'll explain how those two can be connected in a moment. You all know the movie Pretty Woman. It's a fun movie and was a big hit. Julia Roberts asks Richard Gere, "What do you do?" Richard replies, "I buy companies." Buying companies, that's what private equity funds do. Private equity has grown steadily and rapidly since the 1980s. When they buy a company, they can buy it on a friendly or hostile basis. In the film, Richard Gere plans to take over a shipbuilding company in a hostile bid, breaking it up into pieces and selling them off one by one. The old man, the owner of the company, is very upset. Still, over the course of a couple of days that he spends with Julia, he changes his mind and comes to an amicable agreement that the owner can continue to run the business, and he provides the company with sufficient funds. In the early days of private equity, hostile takeovers were seen very unfavorably, and those attempting to acquire companies in this manner were labeled corporate raiders. However, since the 1990s, with the maturation of the financial sector and acknowledgement of their constructive contributions, private equity funds have become a crucial component of the financial industry. Private equity funds refer to a fund that raises money, but it also refers to the fund companies that create and manage such funds. Venture capital firms are also a type of private equity, but we're going to focus on buyout funds, which are firms that invest in companies for the purpose of acquisition. Why do we call it private equity? Private equity refers to equity stakes in companies that are not publicly traded, that is, private companies. Private equity funds typically invest in companies that are not publicly traded, or they buy publicly traded companies and take them private because they need to gain enough control of the company to be able to make important managerial decisions. Financing is also usually provided by private institutional investors, such as pension funds, sovereign wealth funds, insurance companies, or foundations. Sovereign wealth funds are government organizations that are primarily funded by their country's foreign exchange reserves. Norway, China, Abu Dhabi, and Kuwait have large sovereign wealth funds. PEFs also use a lot of private information in addition to public information. This is why they are called private funds, to reflect their private nature. The table on the right lists some of the largest PE firms in the world. You're probably familiar with firms like Blackstone, KKR, and Carlyle, right? 7 of the top 10 are American firms. This illustration shows the entire process of a PE firm, from finding a target company that is a good candidate for a deal, which is called deal sourcing, to finally finalizing the acquisition of the company, which is called deal closing. Every step of the way is important, but due diligence is crucial. Once you've made the acquisition, it's very important to drive up the value of the company, and then it's also very important to make sure that the company is valued well enough so that you can dispose of it and recoup your investment. In due diligence, you research and analyze the target company and its industry to create a financial model. This is the heart of the due diligence phase, as 80% of what you need to know in due diligence is revealed by creating this model. This model will show you the current value of the company and its potential to add value in the future. It shows you what the company's cash flow has been over the past few years, how it's performed, and how much money you'll need to invest in the future, estimating what its cash flow will be and what its profits will be. The price you pay for the company will be based on this model, which is why it's so important. To make the due diligence more accurate, they also rely on other experts, especially accounting and legal advice. When you buy a company, how will you finance it? PE firms, even if they have a lot of their own money, tend to mix it with borrowings from banks to finance it, a leveraged buyout or LBO. Here's a simple example of why. The first method is an LBO. For example, you buy a target company today for $100 million, put up $30 million in equity, and borrow $70 million from a bank. After 5 years, you pay off the bank loan of $40 million and sell the company for $110 million, which is a return of 2.7 times your initial investment. The second option is to not borrow at all and to raise all $10 million in equity. If the firm sells the company 5 years later and receives $150 million, it will only get 1.5 times its initial investment. You can see that the return is very low compared to the previous borrowed purchase. This is why PE firms, when buying a company, try to reduce equity capital as much as possible and increase bank borrowing. It's important to analyze the potential of a company and buy it well, but once the deal is done, they say that the work is only beginning. It usually takes about 6 months to a year to identify and finalize a deal, while it takes about 5 years to enhance the value and dispose of it. It's not just about time, it's also about the importance of the work after the acquisition. How well a fund can unlock a company's potential and increase its value is a true measure of its expertise and quality. The fund sits on the board, consults with management, develops new businesses, new strategies, and injects additional capital if needed. When a firm believes a company has grown sufficiently in value, it will seek to dispose of it, either take the company public and list it on an exchange, or sell it. A PE firm usually takes the form of a limited partnership. The firm may create multiple funds, each of which is also a limited partnership, with the PE firm being the general partner, or GP, of the fund, and the investors in each fund being the limited partners, or LP, of the fund. The companies in which each fund invests are called portfolio companies. In exchange for managing the funds for the LPs, the GPs receive 2 types of fees: a management fee, which the fund company uses to pay for the company's expenses, such as labor and office maintenance. The other is a performance fee, which is a reward for good investment performance, sometimes called a carried interest, or just carry for short. Let's take a simple example. An investor commits to investing $100 million in a fund, and as part of the deal, the management fee and performance fee are 2% and 20%, respectively, and the hurdle rate is 8%. 5 years later, the fund is worth $150 million. The investor must pay a management fee of $2 million per year, which is 2% of the $100 million investment commitment. If the return on the investment exceeds the hurdle rate, which is 8% per annum, the investor pays the fund company 20% of the excess. To calculate the hurdle rate first, 8% compounded over 5 years on $100 million is $147 million. The excess is $3 million, and the investor pays 20% of that, or $0.6 million, as a carry to GP. To summarize, GP can only earn carry if it outperforms its hurdle rate, and only then can it grow. In other words, the fact that a private equity firm has been very successful is a testament to the company's track record of good management, which is to say, its ability to increase enterprise value. So far, we have discussed private equity funds together. To briefly summarize, a private equity fund is a fund that raises money from mostly private institutional investors, such as pension funds, sovereign wealth funds, and others, and then invests in target companies, or sometimes refers to a company that manages such a fund. I explained that PE firms can only be recognized for their ability if they choose their investment targets well, grow the value of the invested companies well, and make a profit by establishing a good exit strategy. So, guys, what did you think? I'd love to hear your thoughts, and if you have any questions, please leave them in the comments, and I'll try to explain them to the best of my knowledge. I'll see you soon with another fun financial story. Thank you.